December 2, 2001. America's seventh largest company vanished overnight. $70 billion in market value, gone. 20,000 employees lost their jobs and their retirement savings in a single morning. This wasn't a market correction. This was the largest corporate fraud in American history, orchestrated by men in suits who smiled for cameras while burning everything down. This is the story of Enron, the company that fooled Wall Street, the government, and the world. And it started with a simple question no one thought to ask. 1985, Kenneth Lay, a PhD economist with White House connections, merged two pipeline companies in Houston to create Enron. Boring, predictable, safe. Then he hired Jeffrey Skilling, a McKinsey consultant with a radical vision, transform Enron from a pipeline operator into an energy trading powerhouse. Instead of moving gas through pipes, they'd create markets for energy itself, buying and selling electricity and natural gas like commodities on Wall Street. The timing was perfect. The 1990s brought energy deregulation. Suddenly, power could be traded like stocks. Enron built massive trading floors where young MBAs bought and sold megawatts like currency. They attracted Harvard and Stanford's best with massive salaries, stock options, and a culture that worshipped aggression. Enron's Houston headquarters became a temple to corporate ambition, a gleaming tower where the smartest people in the room convinced themselves they were inventing the future. But there was a problem they hadn't solved yet. The numbers told an intoxicating story. 1990, $9 billion in revenue. 2000, $100 billion. Stock price climbed from $10 to $90 per share. Fortune magazine named Enron America's most innovative company 6 years running. Kenneth Lay graced magazine covers. Jeffrey Skilling gave TED-style talks about the new economy. Wall Street fell hard. Analysts from Merrill Lynch, Goldman Sachs, Credit Suisse issued glowing reports with strong buy ratings. Market caps soared past $70 billion, more valuable than General Motors. Pension funds, university endowments, retirement accounts all wanted in. Enron employees were encouraged to invest their 401ks in company stock. After all, it only went up. Behind the scenes, Enron expanded into bizarre territories. Enron Online handled $6 billion in daily transactions. They built power plants in India and Brazil. They tried to commoditize internet bandwidth, convinced they could trade anything. Annual reports read like science fiction, asset-light business models, intellectual capital, promises to revolutionize energy, water, telecommunications, even weather insurance. And everyone believed them, because the stock kept climbing, because earnings always beat expectations, because Enron had become too big, too successful to question. But one journalist was about to ask a very simple question. March 2001. Fortune journalist Bethany McLean published an article titled, "Is Enron Overpriced?" She asked, "How exactly does Enron make money?" Skilling responded with rage, calling her unethical. But the question lingered, because beneath the gleaming surface, something was rotting. Enron's profits weren't real. They were accounting illusions, constructed by CFO Andrew Fastow and blessed by Arthur Andersen, one of the world's most prestigious accounting firms. Fastow created hundreds of off-balance sheet entities, shell companies with names like Chuco and Raptor, designed to hide Enron's debts and inflate profits. Here's the scheme. Enron sold assets to these shells at inflated prices, booking immediate profits. The shells were funded with Enron's own stock, creating a circular loop of fake value. Losses vanished. Debts disappeared. Every quarter, Enron beat Wall Street's expectations. Skilling pioneered mark-to-market accounting. Sign a 20-year energy deal? Book 20 years of projected profits today. It didn't matter if the profits never materialized. The numbers looked spectacular on paper. In August, Sharon Watkins, an Enron VP, sent an anonymous memo to Kenneth Lay warning the company might implode in a wave of accounting scandals. Lay did nothing. The machine was too profitable to stop. But the machine was about to break. August 14, 2001. Jeffrey Skilling abruptly resigned as CEO after just 6 months. Personal reasons. The stock began sliding. October 16. Enron announced a $618 million loss and a $1.2 billion reduction in shareholder equity. The SEC opened an investigation. Stock plummeted to $20. October 22nd. Fasto was fired. October 27th. Enron burned through $1 billion of credit in a desperate attempt to stay afloat. Credit agencies began downgrading their debt. Without investment-grade ratings, the trading operation would collapse. No one would do business with them. November brought a death spiral. Enron tried merging with Dynegy in an $8 billion deal. For a moment, salvation seemed possible. But when Dynegy's lawyers examined the books, they found a nightmare. The debts were catastrophic. The accounting was fraudulent. November 28th. Dynegy walked away. Enron stock fell to $4. December 2nd, 2001. Enron filed for Chapter 11 bankruptcy, the largest in American history. $70 billion in market value, gone. 4,000 employees were escorted out by security guards immediately. 16,000 more would follow. Their 401k accounts, heavily invested in Enron stock, were worthless. People who'd worked for decades lost everything. Employees who'd been millionaires on paper discovered their stock options were toilet paper. Some had taken loans against Enron shares to buy houses. Now they faced foreclosure. Several Enron employees and investors committed suicide. But the reckoning was just beginning. The trials began in 2004. Andrew Fasto, architect of the fraud, pleaded guilty. 6 years in federal prison. He forfeited $29 million. Jeffrey Skilling went to trial in 2006 on charges of fraud, conspiracy, and insider trading. He claimed ignorance of the accounting schemes. The jury didn't buy it. 24 years in prison. $45 million in fines. Kenneth Lay was convicted on 10 counts of fraud and conspiracy, facing decades behind bars. But before sentencing, Lay died of a heart attack in July 2006 while vacationing in Colorado. The Enron scandal revealed something dark about human nature and corporate culture. It showed how intelligent people can convince themselves that fraud is innovation, that deception is strategy, that rules don't apply to them. Enron's executives weren't cartoon villains. They were brilliant, educated, ambitious people who made a series of choices, each one seemingly small, each one crossing a line, until they'd built a cathedral of lies. They believed their own mythology. They thought they were smarter than everyone else. That arrogance blinded them to the human cost. The lesson isn't just about accounting fraud. It's about what happens when we worship success without questioning how it's achieved. When we celebrate stock prices over substance. When we let complexity obscure truth. When we trust institutions simply because they're prestigious. 20 years later, the patterns repeat. Different companies, different schemes, same psychology. Because the incentives haven't changed. The culture that produced Enron, the obsession with quarterly earnings, the pressure to meet Wall Street expectations, the belief that ends justify means, still exists. If this story fascinates you, subscribe. Because Enron wasn't the first, and it won't be the last. And the next time someone promises revolutionary returns with complex explanations, you'll know what questions to ask.